This is Kurt Heisinger, accounting professor at CR College and author of Managerial Accounting. This video describes how to estimate fixed and variable costs given historical information. Companies typically do not know exactly which costs are fixed and which costs are variable and how much each of those costs represent. So we can use four different approaches to estimate the fixed and variable components of historical cost information. The four different approaches are listed here as the account analysis approach, the high-low method, scatter graph method, and regression analysis. We focus on account analysis in this video, and there'll be three separate videos where we will be describing the high-low method, scatter graph method, and regression analysis. Regardless of the approach that's used, our goal is going to be to estimate the fixed and variable cost components of historical information, and then once we have that information, to go ahead and state it in the form of an equation. And that equation is listed here. We're looking at calculating total mixed costs by identifying the total fixed costs, the variable costs per unit, and then basically plugging in the number of units to establish what we think the total mixed cost will be. We state that in the equation form that you see here, where y is our total cost, f is the total fixed cost, v is the variable cost per unit, and we multiply that times x, the level of activity, typically stated in number of units, and then it gives us the total variable cost. So again, y is the total mixed cost, and it equals the total fixed cost plus the total variable cost. How do we use account analysis then to determine or estimate our total fixed costs and our variable cost per unit? Well, this approach requires that we have at least one experienced employee, if not several, to review historical account information and to take that information and classify those costs as either fixed or variable. The fixed costs are basically totaled to provide an estimate of our total fixed cost. We'll give you an example here in just a minute. And the variable costs per unit are calculated by dividing whatever our total variable costs are by the measure of activity. And the result will be expressed using the equation that we just talked about, y equals f plus vx. I've been using this Bikes Unlimited example throughout our discussions of cost estimation, and the main reason is because I use that in my textbook, but it's fine to use it generically here. So let's assume that our company is Bikes Unlimited and that we produce mountain bikes and sell those mountain bikes to retail stores. The example that we have here shows that we produced 5,000 units and sold those units. Let's assume over the course of the last year. We're using historical information. Let's assume that we're looking at this past year's historical information and that we produced 5,000 units. We have an experienced employee looking at the books, and again, back in time, for our production department. We're focusing on the production department here in this example. And this experienced employee looked at the books and determined that we had materials that were used in production, labor used in production, and some production facility costs. The total costs were $290,000. What this employee is going to do then is to take that $290,000, analyze the accounts, and determine how much of that $290,000 was variable and how much was fixed. This employee then determined that, I'll take these line by line, that for the materials that were used in production, this $180,000, all of those materials were determined to be a variable cost and therefore are in the variable cost column. The labor that was used in production looks like $65,000 of that was broken out. It looks like $65,000 of that was variable, typically the assembly line workers, and $15,000 of that was fixed. Maybe it was the supervisor in the production process. And for the third line item, we had production facility costs. It looks like we had $30,000 in total. $15,000 of that was variable, and $15,000 of that happened to be fixed. So the variable component could be the utilities, and the fixed component could be, for example, the rent on the production facility. I know I said these costs were for last year, but looking at these dollar amounts, it's probably better to make the assumption that these were for last month, that it was for 1 month. So let's just go with that assumption as we move ahead with this information. Now we have the information that we need to predict costs in our production facility in the future, in future months. What we're looking at is we have total fixed cost estimated to be $30,000. That's the cost that's not going to change in the future as we change the level of production. And we have variable costs per unit of $52. And that's the cost in total that will change in the future as we change level of production. That $52 was calculated by taking our total variable costs from the previous slide of $260,000 and dividing it by the number of units that we produced last month, 5,000 units. $260,000 divided by 5,000 units gives us $52 per unit. Remember, the goal is to describe the mixed cost in the equation form of y equals f plus vx so that we can plug in x, the number of units produced, to estimate our y cost in the future. This results then in the equation y equals $30,000 in total fixed costs plus $52 in variable cost per unit times x, the number of units. And so an example of how we would use this, maybe we're looking ahead at a future month and we think that we're going to produce 6,000 units. I'm going to plug in 6,000 units here. Let's just assume that we're going to produce 6,000 units in the future. We want to know what our production costs will be. We want to estimate our total production cost based on the goal of producing 6,000 units. What we would do is to plug in 6,000 units for x and solve for y. And what that means is we're going to have $30,000 in total fixed costs that won't change, and we're going to add to that our total variable costs. And we find the total variable costs by taking $52 per unit times 6,000 units. And if you do that, the $52 per unit times 6,000 units equals $312,000, and we add to that $30,000, and that gives us a total for y of $342,000. And that would then be our estimate for the future month where we expect to produce 6,000 units. That is, we would expect our total production cost to be $342,000.